Have you ever looked at a huge, rock-solid tech company and wondered, how on earth could its stock suddenly take a massive nosedive? Well, today, we're going to unpack exactly that, using the fascinating case of Oracle's dramatic tumble to see just how it can happen. So yeah, that's the big question, isn't it? How can a tech giant actually fall? I mean, it's a real puzzle. You've got this company, a leader in its field with a long history of success, and then all of a sudden, it's in a free fall. So what causes that? And maybe more importantly, what can it teach all of us about how the market really works? To really get the story of the fall, you first have to appreciate just how high they were flying. So let's start there. Let's look at the foundation Oracle built and the powerhouse reputation it had in the tech world. For decades, Oracle was what investors call a blue-chip company. And if you're not familiar with the term, just think of a mature, stable giant. I mean, this is a company known for its super reliable database software and powerful business solutions. This is not some flashy new startup. This is a pillar of the entire tech industry. And this is a big reason why everyone saw them as so stable. Oracle's whole business stood on these four massive pillars. You had their legendary database software, the essential applications that big companies run on, their growing cloud services division, and of course, all the hardware to power it. On paper, it looks about as robust as you can get. But, and there's always a but, right? This is where the tension really starts to build. See, the market wasn't just looking at the solid company Oracle was today. It had built up this huge expectation bubble, pricing the stock based on incredibly high, almost unrealistic hopes for the future. And right here, you can see the disconnect. The market was betting on explosive, off-the-charts cloud growth. They expected Oracle to just dominate and gain massive market share. The reality? Well, it was a lot more modest. The growth was slower, and the competition was getting really, really fierce. Now, here's the crucial point. The performance wasn't bad, not at all. It just fell way short of the hype. So what happens when a bubble of expectation like that finally pops? Well, you get a sharp, sudden decline. Let's break down exactly how and why it happened piece by piece. And wow, the reaction was fast. I mean, incredibly fast. On day one, everything seems fine. Investor optimism is high. Then boom. Day two, the earnings report drops. And it's a miss. Not a miss on profits, but a miss on those sky-high expectations we talked about. Within a single week, the stock price just plummets. And by week two, the whole story has flipped, with the media all over it and analysts downgrading the stock left and right. So what was really going on under the hood here? Well, this wasn't just one thing. It was a perfect storm, really, of four key factors all hitting at once. You had concerns about their earnings. You had that fierce competition in the cloud. You had intense pressure from that super high valuation. And of course, you can't ignore what was happening in the broader market at the time. Let's just focus on that valuation pressure idea for a second, because this is so important to get. Think of it like a Jenga tower. The higher the stock price gets without the actual performance to support it, the more wobbly that tower becomes. It doesn't take a big push, just one little piece pulled out, like a slight mess on expectations, to send the whole thing tumbling down. And that intense cloud competition factor, you can really see it in action here. You see, Oracle's growth wasn't negative or anything. It was still growing. It was just lagging behind. So when investors saw their key competitors growing so much faster, it just poured gasoline on the fire of their disappointment and confirmed all their fears that Oracle might be losing its edge. Now, a big market shock like this, well, it's not experienced the same way by everyone. The impact it has on you depends almost entirely on your perspective as an investor, specifically what your time horizon is. Think about it. A short-term trader, someone who's reacting to the daily headlines, they probably panicked. They saw the drop, got scared, and sold at a loss. But a long-term investor, someone who's focused on the actual fundamental business, they might have seen this dip as a huge buying opportunity, feeling confident in the company's long-term stability and just collecting those dividend payments while waiting for the rebound. So after all that, what are the practical takeaways? What can we actually learn from Oracle's fall? Well, this is the investor's playbook, pulled directly from this whole story. All right, lesson number one, and this is a big one. Size is not a shield. No company is too big to fall. Even a blue-chip behemoth, an absolute giant like Oracle, is not immune to a major market correction, especially when expectations get so out of whack with reality. This one is so crucial to understand. A company can be posting record profits, rising revenues, all good news headlines, right? But if the market was expecting even more, the stock will still fall. It's the gap between what was expected and what was delivered, that really drives the stock price, not the headlines themselves. Let's be honest, when a stock is dropping fast, our natural human reaction is fear. Your gut just screams, "Get out now." Panic selling feels like the safe move. But this whole event shows the incredible power of discipline, of sticking to your original analysis and your long-term plan instead of just reacting to the noise and fear of the moment. Okay, so let's tie this all together. Here are your key takeaways. First, even the giants can stumble. Second, you have to understand the incredible power of market expectations. Third, diversification is your best friend and essential defense. Fourth, emotional discipline is absolutely critical. And finally, always focus on the long-term quality of the business, not the short-term blips in the stock price. You know, if you remember just one single thing from all this, let it be this quote right here. Volatility, those big swings up and down, it's just a natural part of the market. The goal isn't to try and avoid it, because you can't, but to understand what causes it so you can navigate it wisely. And that leaves us with one final, pretty provocative thought. After seeing what can happen to a titan like Oracle, you really have to ask yourself, in today's fast-moving market, is any company out there truly too big to fall? Definitely something to think about.